This presentation is about the report to Parliament, Results of Audit, Local Government Entities, 2013-14. Each year, every Queensland public sector entity is subject to a financial audit. Our audits provide the users of financial statements with independent assurance that they are reliable and comply with prescribed requirements. The public sector has high standards of accountability in the probity and propriety of its activities. We design our audit procedures to address any risks associated with an entity's financial report. We are wholly committed to helping the public sector improve. This report summarises the results of our financial audits of all entities in Queensland's local government sector for the last financial year. There were 154 entities in the sector that were required to prepare financial statements in 2013-14, including 77 councils. We report on the audit opinions we have issued, significant financial reporting issues, the time taken by councils to prepare their financial statements, and the quality of the financial statements provided to the auditor. We also report on the significant control issues that we have identified during our audits, as well as providing our assessment of each council's financial sustainability. As well as providing an audit opinion on the general purpose financial statements of councils, we also provide an opinion on the current year financial sustainability statement. It is important to note that our opinion on the current year financial sustainability statement only relates to whether the three legislated financial sustainability ratios have been accurately calculated. We do not form an opinion on the appropriateness or relevance of the reported ratios, nor on the council's future sustainability. Only one council and 5 related entities received a qualified audit opinion on their 2013-14 financial statements. This meant that 96% of entities in the sector received an unmodified audit opinion, meaning their financial statements were prepared in accordance with legislation and relevant accounting standards. While this is a good result, there are still 8 council audits and 1 audit of a council-related entity still in progress. Unfinished audits regularly indicate issues that translate into qualified opinions. This year, for the first time, we have included in our report an assessment of each council's financial governance. This is in the form of a traffic light report, which also allows a comparison to be made against like councils. The assessment covered the timeliness of financial statements, the quality of statements provided to audit, the number of significant control issues raised, and our assessment of the council's financial sustainability. A red traffic light means the council has missed the legislative reporting deadline, provided poor quality financial statements to audit, had high risk or greater than 5 moderate control issues raised by audit, or been assessed as being a higher risk of becoming unsustainable. Our assessments of the individual councils by name are included in Appendix H of our report. Our assessment indicates that timeliness and quality of financial reporting is a low priority for a third of councils, while almost half of all councils experience significant control breakdowns. There are also 16 councils at a higher risk of becoming unsustainable. Many of these were Indigenous councils or councils in high population growth areas. It is important to remember this assessment is based on actual results over the past 5 years, and on the premise that if this actual experience continued, the risk of councils becoming unsustainable increases. As mentioned, there are 8 council audits that are still unfinalised, while a further 17 councils missed the 31 October deadline for completing their financial statements. This is a poor reflection on the sector, with 32% of councils not giving priority to timely financial reporting back to their communities. The longer it takes to publish an annual report, the less useful it is to the users. We have recommended that the department considers introducing measures such as incentives or penalties to improve compliance with reporting deadlines. We compared Queensland to councils audited by Auditors General in Tasmania, Victoria and New Zealand, with Queensland showing little urgency in completing their financial statements. Where councils in other jurisdictions missed their reporting deadline, they still completed their statements within a month. There is a direct link between the timeliness of financial reporting and the number of weaknesses we identified in councils' internal controls. Councils that missed the reporting deadline had the majority of audit issues we reported. Across the sector, we have not observed any significant improvement in councils' internal control frameworks over the years. Furthermore, in the past 3 years, almost a third of our issues remain unresolved and need to be re-raised in the following year. Almost half of our significant audit issues relate to Indigenous and resource councils. These councils also made up half of those which missed the financial reporting deadline. Poor management attitudes to control and ineffective oversight and monitoring of controls persist across the sector. We also reported on 3 significant financial reporting issues: asset management frameworks across councils, outcomes from council de-amalgamations, and council management of goods and services contracts. As councils are the stewards of major public infrastructure, asset management is a cornerstone of their long-term financial sustainability. However, the benefits of robust asset management are not clearly understood. Plans are not regularly updated, and annual asset valuation processes continually identify significant data errors, which means councils are making decisions based on inaccurate or incomplete data. We have recommended to the department that they assist councils in asset management practices by providing training, better practice guides, or sourcing external expertise. We also looked at outcomes from the de-amalgamations that occurred in 2013-14. The 4 new councils began operating on 1 January 2014. While work still needs to be done in embedding processes and systems and finalising policies, all councils have made considerable progress. All 4 councils are forecasting improvement in their operating results over the next 3 years. It is important that these councils focus on asset management to ensure long-term financial sustainability. We also examined councils' management of major goods and services contracts. Councils spend around $3.4 billion annually on materials and services. To achieve long-term value, councils must have sound contract management practices and must manage contracts throughout their life. We found almost half the councils did not have a central contract register, while a further half also had no documented support for decisions made at the end of contracts to renew, extend or re-tender the arrangements. We also found that processes for monitoring supplier performance could be improved. Overall, we've made 3 recommendations for improvements across the local government sector. We trust this presentation has been of value. The full report can be found on the Queensland Audit Office website. Thank you.